Ladies and gentlemen, something dangerous is happening beneath the surface of the global economy, and almost nobody is talking about it. While the media keeps distracting people with temporary headlines and false confidence, the real warning signs are flashing red right in front of us. Debt is exploding, banks are under pressure, central banks are trapped, inflation is far from dead, and now, silver, the most undervalued hard asset on the planet, is beginning to send a signal that could shock the financial world in 2026. Most people still believe markets are stable. They believe the system can keep printing money forever without consequences. But history tells a very different story. Every major economic collapse was preceded by warning signs that the average investor ignored. Today, those same signals are back stronger than ever. And if silver reaches 3D30, it will not just be a price move, it will be a message that confidence in the financial system is breaking apart. The smart money is already preparing, governments are preparing, institutions are quietly repositioning, but average people are still asleep, waiting for permission from mainstream media to panic. By the time the headlines admit what's happening, it will already be too late. The next market crash won't look like the last one. It will move faster, hit harder, and expose weaknesses most people never saw coming. Tonight, we are going to uncover why silver may become the biggest financial warning signal of this decade, why 2026 could change the wealth of millions overnight, and why those who understand this shift early may protect themselves while others are caught completely unprepared. Most people think economic collapses happen suddenly. They imagine one dramatic moment where the stock market crashes, banks fail overnight, and panic spreads across every television screen in the world. But real financial collapse does not begin with chaos on the surface. It begins quietly underneath the system while the public is distracted, entertained, and convinced everything is stable. By the time ordinary people notice the damage, the smart money has already moved, governments have already reacted, and the financial elite have already positioned themselves to survive what's coming next. Right now, beneath the headlines and political theater, the global economy is showing the same dangerous signals that appeared before every major financial disaster in modern history. Debt levels are out of control. Consumer confidence is weakening. Banks are carrying hidden risks that most people cannot even see. Governments continue spending money they do not have while central banks try desperately to hold the entire system together with printed currency and manipulated interest rates. The public is being told that inflation is cooling, growth is returning, and stability is near, but the numbers beneath the surface tell a completely different story. One of the biggest dangers in modern economies is the illusion of strength. Governments and financial institutions understand that confidence is everything. The system only works if people believe it works. Banks only survive if depositors trust them. Paper currencies only hold value if citizens continue believing in them. Stock markets only remain elevated if investors think growth will continue forever. The moment confidence breaks, the entire machine begins to shake violently. That is why authorities constantly repeat optimistic narratives even when economic foundations are deteriorating in real time. The average person looks at stock indexes reaching new highs and assumes the economy must be healthy. But markets today are being supported by artificial liquidity, massive debt expansion, and financial engineering unlike anything seen before. Central banks around the world injected trillions of dollars into the financial system over the last several years. That money did not disappear. It flooded into assets, inflated housing markets, pushed stock prices higher, and created the illusion of prosperity. But printing currency does not create real wealth. It only delays consequences while silently destroying purchasing power. Millions of families are already feeling the pressure, even if official statistics try to hide it. The cost of food has surged. Energy prices remain unstable. Housing affordability has collapsed in many parts of the world. Credit card debt is exploding as ordinary people struggle to maintain lifestyles they could once afford comfortably. Savings are shrinking. Small businesses are being crushed by rising operational costs. Yet governments continue insisting the economy is resilient because they cannot afford for the public to panic. History shows that every empire eventually reaches a point where debt becomes impossible to control. Instead of solving the problem through discipline and restructuring, leaders usually choose the easier path: currency creation. They print more money, borrow more aggressively, and hope future growth will solve current problems. But eventually, the debt grows faster than the economy itself, and the entire system becomes dependent on endless stimulus just to survive. That is exactly where many major economies stand today. What makes this situation even more dangerous is the interconnected nature of the modern financial system. Banks, governments, hedge funds, pension systems, and multinational corporations are all deeply connected through derivatives, bonds, leverage, and digital financial networks. A crisis in one sector can rapidly spread across the entire global economy within days or even hours. The world experienced a glimpse of this during previous banking crises when institutions collapsed almost overnight despite appearing stable only weeks earlier. Many people still believe governments will always step in to save the system. In some cases, they will try, but every rescue creates another layer of weakness. Bailouts require more debt. More debt requires more currency creation. More currency creation weakens purchasing power further and fuels long-term inflation. Governments are trapped in a cycle where every temporary solution creates an even bigger future problem. They are no longer preventing collapse, they are postponing it. Another warning sign hiding beneath the surface is the growing divide between official economic data and everyday reality. Politicians speak about strong labor markets while millions of people work multiple jobs just to survive. Officials celebrate economic growth while middle-class purchasing power continues collapsing. Media headlines claim inflation is under control while grocery bills remain painfully high for average families. This disconnect between official narratives and lived experience slowly erodes public trust, and once trust begins disappearing, financial systems become extremely fragile. The banking sector itself is also facing enormous pressure. Rising interest rates expose vulnerabilities that had been hidden for years during the era of cheap money. Many institutions loaded themselves with long-term assets when rates were near zero, assuming easy monetary conditions would continue indefinitely. When rates rose aggressively, the value of those assets dropped sharply, creating losses beneath the surface that many depositors still do not fully understand. Several institutions already experienced major stress, and central banks were forced to intervene quickly to stop wider panic from spreading. Commercial real estate is another ticking time bomb sitting quietly inside the economy. Office buildings in many major cities remain partially empty while debt tied to those properties continues maturing. Property owners who borrowed heavily during low-rate environments are now facing refinancing costs that are dramatically higher. Defaults are increasing slowly but steadily. Regional banks heavily exposed to commercial real estate may face enormous stress if conditions continue worsening. At the same time, geopolitical tensions are adding another layer of instability to an already fragile system. Trade wars, sanctions, energy conflicts, and military tensions between major powers are reshaping global markets. Countries are beginning to question dependence on the existing financial order. Some nations are increasing gold reserves aggressively while reducing exposure to foreign currencies and debt instruments. This movement signals declining confidence in long-term monetary stability. Perhaps the most dangerous factor of all is how psychologically unprepared the public remains. Most people have been conditioned to believe governments and central banks can always control outcomes. They believe technology, financial innovation, and modern policy tools have eliminated the possibility of systemic collapse. But history repeatedly proves that human nature never changes. Excessive greed, reckless speculation, unsustainable debt, and blind optimism always appear before major financial downturns. During bubbles, people stop asking hard questions. They begin assuming asset prices only move upward. Risk management disappears. Speculation becomes normalized. Social media influencers promote unrealistic wealth fantasies. Retail investors pour money into overheated markets because they fear missing out. This emotional behavior creates instability beneath the surface long before visible collapse begins. The signs are already emerging everywhere. Layoffs are increasing in sectors once considered untouchable. Consumers are relying more heavily on debt to survive. Young generations are losing faith in traditional financial systems because wages no longer keep pace with living costs. Retirement systems face growing pressure as populations age and government obligations expand beyond sustainable levels. These are not isolated problems. They are symptoms of a deeper structural crisis building quietly underneath the surface. One of the clearest signals of hidden economic weakness is the growing interest in hard assets. Throughout history, whenever trust in paper systems begins weakening, money flows toward tangible stores of value. Gold and silver are not simply metals, they are indicators of confidence. When investors begin aggressively accumulating precious metals, it often reflects growing fear about currency stability, debt sustainability, and systemic risk. Silver is particularly important because it exists at the intersection of monetary fear and industrial necessity. Unlike many assets driven purely by speculation, silver plays a critical role in modern technology, energy systems, manufacturing, and electronics. At the same time, it has served as real money for thousands of years. This combination makes silver uniquely positioned during periods of economic instability. Rising demand colliding with tightening supply could create explosive moves that catch most investors completely off guard. Meanwhile, central banks continue walking a dangerous tightrope. If they keep interest rates high to fight inflation, they risk breaking heavily indebted economies and financial institutions. If they lower rates too aggressively or resume large-scale money printing, inflation may accelerate again and destroy confidence in currencies even faster. There is no painless solution left because the underlying structural problems were allowed to grow for far too long. The frightening reality is that many of the systems people rely on today are functioning only because confidence still exists. Pension funds depend on stable markets. Banks depend on depositor trust. Governments depend on continued borrowing. Currency systems depend on belief. But confidence is psychological, and psychology can change extremely fast under pressure. Once fear replaces trust, events move much faster than most people expect. In previous decades, crises unfolded more slowly because information traveled at a different speed. Today, panic can spread globally within minutes. Social media, digital banking, algorithmic trading, and interconnected financial systems create conditions where fear can move faster than governments can respond. A rumor, a bank failure, a currency shock, or a sudden liquidity event could trigger massive reactions before policymakers even hold emergency meetings. The hidden collapse already starting behind the scenes is not only financial, it is also social and psychological. People are becoming more frustrated, more divided, and more uncertain about the future. Economic stress changes societies. It increases political instability, weakens trust in institutions, and creates anger towards systems perceived as unfair or corrupt. Throughout history, financial crises have rarely remained limited to economics alone. They often reshape politics, culture, and global power structures for generations. The wealth gap has widened dramatically over recent years, and this creates another layer of instability. Asset inflation primarily benefited those who already owned stocks, real estate, and financial assets, while ordinary wage earners struggled with rising costs. Many citizens now feel locked out of the economic system entirely. When enough people begin believing the system no longer works for them, social cohesion weakens rapidly. At the same time, artificial intelligence, automation, and technological disruption are beginning to reshape labor markets in ways many people still underestimate. Entire industries may face transformation or displacement over the coming decade. While technology creates opportunities, it also introduces uncertainty for millions of workers already under financial pressure. This transition is happening during a period of enormous debt and economic fragility, increasing the risk of instability even further. Governments may attempt temporary solutions through stimulus programs, digital currencies, financial controls, or emergency interventions, but these measures cannot eliminate structural reality. Debt cannot expand forever without consequences. Currency cannot be printed endlessly without affecting purchasing power. Markets cannot detach permanently from economic fundamentals. Eventually, reality reasserts itself, and when it does, adjustments become extremely painful. The people who survive major economic shifts are usually not the ones with the most optimism. They are the ones willing to recognize uncomfortable truths early. They pay attention to signals others ignore. They understand that financial systems move in cycles, and periods of artificial prosperity are often followed by periods of painful correction. They prepare before fear becomes mainstream. Right now, the warning signs are already visible for anyone willing to look beneath the surface. The collapse is not beginning with dramatic headlines or public panic. It is beginning quietly through weakening confidence, rising debt burdens, deteriorating purchasing power, banking stress, and fragile financial structures that depend entirely on continued faith in a system stretched beyond its natural limits. You have not enough humanizer words left. Upgrade your surfer plan. For decades, gold has dominated the conversation whenever fear enters financial markets. Investors run toward it during recessions, inflation scares, geopolitical crises, and currency instability because gold has always represented safety, stability, and preservation of wealth. But something unusual is happening right now beneath the surface of the global economy. Silver is beginning to send a louder and more aggressive signal than gold itself, and most people still do not understand what that means. Historically, silver has often moved later than gold during the early stages of financial uncertainty. Gold usually reacts first because large institutions, central banks, and conservative investors treat it as a primary reserve asset. Silver, however, behaves differently. It begins moving aggressively when fear starts spreading beyond institutions and into the broader financial system. Silver's movements often reflect not only monetary instability, but also stress inside industrial supply chains, manufacturing sectors, and the real economy. That combination makes silver one of the most powerful warning indicators during periods of major economic transition. What makes the current situation so dangerous is that silver is being pressured from multiple directions at the same time. On one side, industrial demand continues growing rapidly because modern technology depends heavily on silver. Solar panels, electric vehicles, electronics, medical equipment, defense systems, and advanced manufacturing all require silver in large quantities. Unlike paper currency, silver is a physical resource with limited supply. Every year, industries consume enormous amounts of it, and much of that silver is never fully recovered or recycled because it is used in tiny quantities across billions of devices worldwide. At the same time, investment demand for silver is also rising because confidence in paper assets is weakening. Investors are beginning to recognize that inflation is not temporary. Debt levels are unsustainable, and central banks are trapped inside a system that requires endless money creation just to survive. This creates a powerful collision between industrial demand and monetary demand, and that collision has the potential to produce price movements far more violent than most people imagine possible. Gold is often viewed as a pure monetary metal, but silver exists in a completely different category. Silver is both an industrial necessity and a form of real money. That dual role makes it extremely sensitive to changes happening inside the economy. When silver starts outperforming gold during periods of instability, it often signals that deeper structural problems are emerging beneath the surface. One reason silver's warning matters so much right now is because the global economy is entering a phase where governments may no longer have effective solutions available. During previous crises, central banks responded by lowering interest rates and injecting liquidity into markets. Those actions temporarily stabilized the system because debt levels were lower and inflation pressures were more manageable. But today the situation is very different. Governments are carrying enormous debt burdens while inflation remains deeply embedded inside the economy. Every policy option now creates serious consequences. If central banks keep interest rates high, they risk triggering bankruptcies, unemployment, housing crashes, and banking failures. If they cut rates aggressively or print more money, they risk reigniting inflation and destroying confidence in currencies. Silver responds aggressively during these moments because it reflects fear about the long-term value of paper money itself. The public still underestimates how much global debt has expanded over the past 2 decades. Governments, corporations, and consumers all became addicted to cheap borrowing during years of ultra-low interest rates. Entire economies were built around the assumption that easy money would continue forever. Housing markets exploded, stock markets soared, businesses borrowed aggressively, governments expanded spending programs without restraint. But the entire structure depended on low borrowing costs and endless liquidity. Now, that inflation forced central banks to raise rates. The cracks are beginning to appear everywhere. Debt servicing costs are rising rapidly. Governments are paying more interest on existing debt. Consumers are struggling with higher loan payments. Businesses are facing shrinking margins. Banks are sitting on losses connected to bonds and commercial real estate. These pressures are not isolated events, they are symptoms of a financial system under enormous stress. Silver detects these pressures faster than many traditional indicators because it sits directly between industrial activity and monetary fear. If economic weakness intensifies while investors simultaneously seek protection from currency debasement, silver can experience explosive volatility. That is why silver often behaves like a pressure gauge for systemic instability. Another reason silver's signal matters more than gold right now is because the silver market itself is relatively small compared to global financial markets. There is simply not enough physical silver available if large numbers of investors suddenly decide they want exposure at the same time. The paper silver market gives the illusion of abundant supply because contracts and synthetic instruments massively exceed the amount of physical silver actually available. But during periods of panic or supply stress, the difference between paper promises and real physical metal becomes extremely important. Throughout history, financial systems function smoothly only when people trust promises. They trust banks to hold deposits. They trust governments to maintain currency value. They trust financial institutions to honor obligations. But when trust weakens, people start demanding tangible assets instead of paper claims. Silver becomes attractive in these moments because it represents something physical, limited, and historically recognized as money for thousands of years. Many younger investors today have never experienced a true monetary crisis. They grew up during decades where central banks appeared powerful and financial systems seemed stable. But confidence in modern monetary systems depends heavily on perception. Most currencies are no longer backed by tangible assets. They are supported primarily by trust, government authority, and debt markets. As long as people believe governments can manage economic problems, the system continues functioning. But once doubt spreads, fear accelerates quickly. Silver's recent behavior suggests that some investors are already preparing for that possibility. Physical silver demand has remained strong even during periods of economic uncertainty. Mints and dealers in several regions have reported tight inventories and growing interest from retail buyers whenever market volatility increases. Large institutional players are also paying closer attention to precious metals as concerns about long-term debt sustainability continue rising. What makes silver especially dangerous for the financial system is how violently it can move once momentum begins. Silver is historically one of the most volatile major assets in the world. During previous bull markets, it dramatically outperformed gold in percentage terms because its smaller market size allows price movements to accelerate rapidly once buying pressure increases. If fear surrounding currencies, inflation, or banking stability intensifies, silver could experience moves that shock even experienced investors. The energy transition taking place globally is another major factor increasing pressure on silver supply. Governments around the world are aggressively pushing renewable energy infrastructure, electric vehicles, and advanced electronics manufacturing. Solar technology alone consumes massive amounts of silver because of its unmatched electrical conductivity. As industrial demand rises year after year, available supply becomes increasingly strained. Mining production faces its own limitations as well. Many silver mines are not pure silver operations. Silver is often produced as a byproduct of mining other metals like copper, lead, and zinc. That means increasing silver production is not always simple or immediate. Environmental regulations, geopolitical tensions, labor issues, and declining ore quality also create long-term challenges for mining